Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So in today's video, we're gonna drink a little bit of Pepsi. We're actually Coke people, me in the metaphorical sense, meaning that we usually do things with the web version of Microsoft Excel, but decided to change it up and use Google Sheets to do velocity banking. And we're actually going to drink a little bit of Coke a little bit later because when we do use a velocity banking calculator, I actually couldn't make it convert into Google Sheets because some of it, for whatever reason, in conversion didn't work. But in today's video, we're going to do velocity banking using Google Sheets instead of Microsoft Excel. And there's free tools that you can use to create these spreadsheets, right? Creating these spreadsheets is not that hard. The only hard thing is not getting the emotional support that you need to do it, because there's going to be a lot of people out there who are going to fear monger you. Oh my goodness, this is going to be the end of the world type of behavior, which I get comments like that in my channel all the time. And again, I don't give you financial advice. This is for informational purposes only. But first, let's ask, what is velocity banking? All it is a financial strategy to pay off your debts quickly using lines of credit as your main tool. And there's really only two things that we need for velocity banking. Number one is a budget, right? So we've certainly done that. And the budget is going to tell you where your holes are in your cash flow bucket, right? And so what you're going to do is write your income, write your expenses, put your leftover savings, have one column as the average American. And what's important when you do your expense breakdown is you list every single debt that you have, right? Because every debt that you have is essentially a hole in your cash flow bucket, and the whole point of the strategy is to quickly pay off debt, right? If you don't have any debt, you don't need any velocity banking. No, sir, or ma'am, you don't need velocity banking, right? Because it's a debt payoff strategy. And the only difference between the average American and the velocity banker is what's your main operating account, right? So your main operating account when doing traditional banking is your checking account, whereas with velocity banking, you don't use that checking account until, or it's not your main operating account until all your debts are paid off, because your main operating account will be your line of credit. Okay, and so you can see that right here. So now what we're gonna do is assume two things, and you can see we have the exact same income. So if you make more income, that's fantastic, and always try to make more income. But our savings is going to go to zero. Like, we're not going to have any savings at all. And you might be thinking, why would you go from $1,300 in savings a month to about zero? That'd be crazy, right? But that's because I'm going to show you an example of how to pay off these debts quickly using your lines of credit as a main tool. And so let's go ahead and copy these, right? These expenses, and re-engineer our finances, right? And so what we're going to do is assume that we have access to something called a home equity line of credit. And if you own a home, you may have access to this, because all it is tied to the value of your home and minus the debts that you paid off. And banks are willing to lend almost like a credit card based on your home equity as collateral, right? You offer collateral, they'll give you better terms and rates, right? So I have a home equity line of credit for about $50,000, but let's assume in this example we have access to a $30,000 home equity line of credit, and it's just all it is a tool that will let you borrow money and pay it back over and over again, right? Kind of like a credit card, but credit cards have a little bit of restrictions. Like, I can't pay credit card 2 with credit card 1, and I can't pay my car loan or my mortgage with credit card 1, because they have different terms and conditions, right? But with a line of credit or a home equity line of credit, I could pay anything I want. That's the beauty of it. I just click a button on the bank's website, and then I got cash in my checking account, and I can pay whatever I want, right? So now let's go ahead and do this and re-engineer our finances. So let's assume that we're able to move all this credit card debt into that home equity line of credit. Okay, so if I add this up, that's I think $28,000 in that I'm able to move in this $38,000 or $30,000 home equity line of credit, and we're going to assume a 10% interest rate. Okay, so what happens when we do that just by doing a simple debt transfer? Zero, 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 right? So now we've magically reduced our expenses, okay? And then we're going to calculate our cash flow, which is C2 minus C3, right? So now, as you can see here, our cash flow has increased. So here we're at savings of $1,300 a month, and now we don't have any savings, and now our cash flow is 2,200. How did that happen? Oh my goodness! Like I have no clue, other than I must have done some sort of magic or something. I don't know. One time, once upon a time, random side story. I actually watched David Copperfield do magic tricks, but it was nothing to this level where he made $1,300 to $2,200 in an instant without making more money. It's insane, right? So now that's what we're gonna do, and what we're gonna do is the actual strategy is put entire paycheck into line of credit and take expenses out, right? And so when we do that, our balance is going to go down by our cash flow, which is about $2,251.60 plus the interest accrued during that period. But putting our entire paycheck is going to do two things: take care of the minimum monthly payment, and then minimize the interest, because the interest is calculated by the average daily balance. So when you put your entire paycheck into that thing, then it's going to lower that balance, or it's going to make the balance at its lowest, right? And so let's go ahead and calculate that. And again, the formulas are the same whether you're using Excel or you're using Google Sheets like I'm doing right now. Again, we usually drink Coke metaphorically, but today we're drinking a little bit of Pepsi. Are you a Coke or Pepsi person? I have a friend who just drinks Coke and will never drink Pepsi, and I think there are people who are like vice versa. I haven't drinking soda in a very long time, right? So, um, if it were up to me, I'd always drink the Mexican Cokes because I think they're higher quality because they don't use high fructose corn syrup. So, shout outs if you like Mexican Coke. Uh, when once upon a time I did drink Coke, right? All right, so now we're going to calculate the next month, and then we're going to calculate the next month's balance, which is the previous month's balance plus the previous month's interest minus the cash flow. So the cash flow here is actually 2251.63, right? And then what we're going to do is calculate the average daily balance, right? So that's what we're going to do. And I got to look for the average function. So I think it's right here. So you look for functions and then do average, right? And then you highlight these two and then you multiply it to get the interest, you got to multiply it by the interest rate. So we're just estimating the average daily balance. It's not necessarily going to be the midpoint between these two. And then you divide by 12 because that's how you get the monthly interest. So the interest is not just 10% of the average daily balance, because think about that, like 2 grand for borrowing 25 grand in credit card debt, that's like two mortgage payments for some people, right? So it's not as much as you think it would be, and some people get surprised like, oh my goodness, this is actually reasonable, right? And so now all we got to do is just copy and paste. Okay, so let's go ahead and copy and paste, and until you see that negative number right here, that means it's paid off then. So let's go ahead and fill this in and make it red, so we know that it was paid off on month 14. And so what we're going to do here is put a milestone and say, okay, and let me go ahead and zoom this out to 100%. On month, so 14 months for 28K of debt, right? 14 months. Crazy. It's crazy how it's just a little bit under a year. Oh my goodness, right? And we make the $5,000 average household income. So if you look up the statistics, the average household income in this country, and it's probably because two people are working in that household, is about 70 to 80K, right? So this should fit the average household income model. And let's just assume that we have a car loan. Okay, so now we got to figure out after 14 months what the balance of that car loan is. You just put that here, 22,000. I auto put it here. Again, go to calculator.net, amortization calculator. It's already calculated for you. You go to monthly schedule, and then you find out after 14 months what's the balance of that loan. Okay, so that's going to be 17 grand. And let's go ahead and put that here, right? 17 grand is the new balance. Okay, and so now what I'm going to do is there's only two loans, right, that you got to pay off: the car loan and the mortgage. And just as a general rule, the mortgage is the very last debt you really want to pay off. Now, I know when people talk about velocity banking, they call, oh, pay off your mortgage in 5 to 7 years, but you have to think of this as a holistic strategy, right? It's not paying off one debt. It's about easily paying off your debts quickly and managing your cash flow. right? So when we did that simple debt transfer, we increased our cash flow immediately. Yet if we focus on paying off the mortgage first, think about this. If we pay off $200,000, we only get $843 back. So it's not too much cash flow in comparison to the loan, okay? But let's figure out what that loan amount is. So let's say $200,000 at 3%, or sorry, 30 years at 3%, okay? And so now, after how many years? 14 months. Let's figure out what the balance of that loan is. So 195, right? So 195. Okay. And so now let's take a look here. So let's take a look at this calculator. And so you could even see at the 3% rate, right? Interest rate, if it's 30 years, you're not just paying 3% of the 200,000, you're actually paying 50% or a little bit more than 50%, right? So in total, you're going to pay 150% here. Oh my goodness, right? So you had a lot of interest that you're paying to that loan. So it's crazy how much even 3% you're paying. And this is why that stream of income is valuable. And if you don't know how banks work, they actually sell these loans um, right after they issue them to what they call the secondary market. And then they sell them to parties who are just interested in receiving the interest stream, the income stream. Now, I know this may kind of get a little bit weird, or I don't know if it's weird, but the banks don't make money off of the loan payments. They just like to broker them for the most part, right? Even though, like, in a lot of videos I say, oh, look how much money the bank's making. I don't want to make it too complicated, but they actually don't get the payments. Someone else is receiving them, and they're getting the right to pay, or to get this income stream. But even at 3%, I mean, take a look at that. 103,000 for $200,000 loan. I mean, if I do 6%, right? Here's what's crazy. You're basically paying two times the house, right? $200,000 and then $231,000. That's $431,000 in total. So what I thought was just going to essentially be a $200,000 house became more than double that. And so, it's crazy how people like try to negotiate with um, get so angsty about like a 20 or $30,000 discount, but they're willing to pay like 100% or even more than 100% to the bank, or not to the bank, but to whoever's receiving the payments, but which we'll call the bank, even if it's technically not the bank. Anyways, all right, let's go back here. So what we're going to do is figure out, all right, which one should we pay off first, the car loan or the mortgage? Now, just by looking at this, because the car loan balance is lower, I'm going to pay that one off first. Like, I can already tell. But let's just go through the debt payoff criteria exercise, right? So there's two ways to figure out what debt you're going to focus on. It's going to be the lowest balance, highest interest rate, and highest payment, right? And so you can see this one actually fits two of the criteria. This one has the highest payment, but this one has the lowest balance and highest interest rate, right? The other way that you know is if you're going to ignore the interest rate and solely focus on the cash flow, there's something called the cash flow index, which is the statement balance over the monthly payment, right? So what you do is just take the formula of the current balance right now, 17,252.37, and then you divide by the monthly payment, which is 405.16, right? And then it gives you a number, 42, and then you would take this one right here, same thing, so 195,116.22 divided by 843.21. And as you can see here, this one's 42 and 231. And if you ever look up the online explanation, it'll say that you pay off the lowest one first, and anything under 50 is, quote, an inefficient loan. Because think about it like this, if the higher the number is, you don't get as much bang for your buck. Like, would you pay $195,000 to only get $843 back, or would you pay $17,000 to get 405 back? Right? So that's essentially what the cash flow index is telling you, how much bang you for your buck you're getting paying off that loan. Okay? Now, let's go ahead and pay off this car loan first. So we're going to definitely pay off this car loan, which is going to be 17 grand. And so we can move this to the HELOC since it's paid off, but I don't think it's necessary. Usually with lower interest rate loans, unless I'm having a line of credit that's at that interest rate, or lower or very similar, I'm probably going to just do what we call incremental payoff or paying off in chunks, because the whole point of this at this stage, again, to manage your cash flow, make sure that your income is not segregated and you're able to put your entire paycheck in one place. Because if you ever look at the statistics for loan payoffs, especially with mortgages, the average American takes 55 years to pay off their original home, like their home, right? So the reason why that is because they refinance, and then when they see a lower monthly payment, they say, "Ooh, like it helps me easier manage my cash flow." And then they're probably just paying more in the end because when they refinance, yeah, they may get a lower monthly payment, but they might be taking out more equity, or it might be the same interest rate, and they refinance, and then they might be paying more just because the length of time has increased, um, with a lower monthly payment, right? So there are certain circumstances where refinancing might be good, but if somebody's offering you something, they probably have an agenda as to why they're offering it, right? Even me, right? I have an agenda when I make these videos. I get YouTube income, and I also make commissions off of selling educational products. Now, I've only sold it to two people online so far, full disclosure. So if you want to be the third person, go ahead and click the Google form link below. So, anyways, all right. So let's go here. Now, here's the thing. We're at Pepsi right now, but today we're going to drink a little bit of Coke still because I couldn't get this velocity banking calculator to work in Google Sheets. So let's just fill in the information, right? And this is a velocity banking calculator provided by Renatus. And I'm actually a Renatus student, right? So if you want to learn from them, I'll enroll you in their classes. And this is where I originally learned velocity banking from. They provide this cool calculator. Now, some people ask, like, can I get this calculator? I say, sure, if you want to enroll in as a student. But sometimes, people just want free stuff and they don't want to invest in themselves, which is kind of sad. But that's a story for another day. Okay, so now let's go ahead and put in this information here. So what's the car loan right now? It's 22. Oopsie. Let me go ahead and put that in right here. So it's 22,000 as the original balance. What's my current balance? It's 17,252.37. 17,252.37. The interest rate is it 4%? Yes, it is 4%. How many years? It's going to be 5 years. And what's the payment amount, which is 405.16? 405.16. And then what we're going to do is just kind of do a little bit of tests. So what we're going to do is put our income, which is about $5,000, and then our monthly expenses is going to be everything except for the loan we're paying off. So we need to include the mortgage. We need to include our general expenses. And so let's go ahead and just sum this up. So this is going to be C12 plus C13, and that's going to be 2343.21, right? So 2343.21, right? And let's just kind of test how much it's going to take with our line of credit. So we'll say that we'll make it equal to the amount of our income that we're moving into the line of credit. And so let's go back here, and then we'll see that, again, with a car loan, you really don't pay that much interest anyways. But this money is really valuable to the car dealerships, because if you try to pay in cash, this is what I've heard. They'll try to charge you a $700 like fee. That's like a bank fee, because if you pay in cash, you're not paying this interest to them, right? It's crazy. And I don't, to be honest, in my world, $1,000 of interest is not that much, especially spread over time. But let's go ahead and pay it off in half a year, and we'll pay $297, right? But let's see what happens if we move the entire thing into the line of credit. 17,252.37. It doubled, right? So that's why I'm saying, like, just do an incremental payoff to that line of credit. Help maintain your cash flow. Put your entire paycheck into one place, and then now you're only paying 297.59 in interest. So that's going to take half a year, according to this. So that half a year is about 6 months. So it's going to take 20 months to pay off how much? So 17, no, 22 grand. So it's going to be 50K. 50K. All right. So it's crazy. It's crazy how you know it still has not been 2 years, and we paid off 50K, right? So we're good. We're done. We're done, right? Now we got to focus on the mortgage. Now I know there's a lot of people who are concerned about, well, if I pay off my mortgage first, then I can't invest in other things, and that's true, right? Like you can't. So everything's, what's more important to you, having less debt or building your wealth? And you could focus on one thing at a time. So you could just uh, focus on paying off your mortgage first and then invest later. Because if you focus on paying off your mortgage first, then having a free and clear home, it provides certain benefits like having a peace of mind. For sure, all you got to do is now just pay your property taxes and your insurance. Um, so me want to focus on paying off the mortgage. We're just going to assume in today's video that we're going to pay off our mortgage. So let's just put our information in that Velocity banking calculator. So now it's, we just got to replace the numbers. And that's why I love this calculator, because I don't have to do that much work and that much thinking. So 195,116. Oh, geez. Did my screen go black? Okay. So 195,116. So 195,116. Actually, this isn't even the rich current balance anymore. We got to add 6 more months. So 20 months, we got to figure it out. It's not going to make that much of a difference, to be honest. So 20 months, what's the balance? It's 192,970. So we didn't we decreased the principal by a couple grand, and take a look here. Even at 3%, most of your money is going to go to interest, right? So 3%. All right, so let's go ahead and put that money here. 3%, 30 years, and we're gonna pay 843.21. 843.21. Okay, and now we gotta decrease this because the car has been paid off. So it's gonna be 15. So let's put a 0 here, and then now this is gonna be 1,500, because we take into account everything except for the loan that we're paying off, because that payment is accounted for here. And then as you can see, it takes us 5 years to pay the sucker off, right? But here's the thing: if we move the entire thing into that line of credit, so let's say we had a huge line of credit, 970.34. Take a look at that. It takes actually longer, and the interest is more. And that's because of the cash flow that you get in paying this off to, and you're transferring this into a higher interest line of credit. So again, we have to think about the cash flow we receive in proportion to the balance of the loan. Like this is why I say, would you pay $200,000 to only get $843 back? Right? It's not that much, but again, we can still focus on it and still save a lot of money, but we're not going to put the entire thing into the line of credit. So as you can see here, 5,000, whether it's 5,000 or 10,000, honestly, it doesn't make that big of a difference. So let me just put 10,000. So it's 5 years and 16 grand of interest. Yeah, so 5 years, 17 grand of interest. And let me actually show you one other thing that I thought was really cool. So let's say we're doing a 30% credit card with this. And, you might be wondering, why would I be using a 30% credit card? But I'm just saying, let's say we do this with a 30% credit card. It only takes 5.1 years, and it's $20,000 of interest, right? So it's not that much. So, all right, so let's go ahead and so write down 5 years. So this is going to be equals 5 times, no, actually 20 times 20 divided by 12, right? So 1.6 years plus 5, that's 6.6 years, right? So it's going to take us 5 years, and it's 6.6 years. So 6.6 years to pay off 250K of debt, okay? Oh my goodness, right? We got to color this in green because this is like the final moment or countdown. Maybe we got to hire an editor to play Final Countdown by Europe. It's really catchy. All right, so now we're pretty much done and we're debt free. Oh my goodness. And take a look at this. This is now 0. And then we got 3,500 in real cash flow that's now going to hit our savings account. And, we have every month we're going to really grow that money without doing anything, right? Our bank account balance is going to really increase without even having to reinvest our money. So we're actually going to have money, unlike your average American who's kind of fake savings with all this debt, right? So, all right. All right. Well, this is Korean Atlanta mentorship. So today we drink a little bit of Pepsi instead of doing Coke, and not that kind of Coke. Naughty mind. Um, with Google Sheets instead of Microsoft Excel, but it doesn't matter what sheet program you're using, just as long as your numbers are accurate. All right. Well, if you're interested in joining a group, go ahead and click the Google form link below. Other than that, have a great day, and we will speak next time.